December 17th, 2025. JP Morgan lost $2.4 billion in a single trading session. Not from a rogue trader, not from a compliance failure. From a short position they couldn't escape. For over a decade, they sold paper silver they didn't own, betting the price would stay suppressed. The bet failed. The physical market broke their paper game. This isn't speculation. This is pattern recognition. There's a three-stage mechanism that governs every commodity squeeze in history. Silver just completed stage 2. The outcome isn't uncertain anymore. It's mathematically inevitable. By the end of this breakdown, you'll understand exactly why JP Morgan's trap was built into the system from day one. Let's start with the mechanics. JP Morgan's silver short position didn't begin in 2025. It began in 2008, right after they acquired Bear Stearns. When they inherited Bear's commodity desk, they inherited a massive short position in silver futures. Instead of unwinding it, they expanded it. For 12 years, from 2008 to 2020, JP Morgan was the dominant short seller in the silver market. The commitment of traders data proves this. Every week, the CFTC publishes a report showing who's long and who's short. Commercial banks, which is code for bullion banks like JP Morgan, were consistently net short by 80,000 contracts or more. One contract equals 5,000 ounces. Do the math. 80,000 times 5,000 equals 400 million ounces of silver sold on paper that they didn't own. Here's how the game worked. When silver rallied, JP Morgan would dump thousands of contracts during low liquidity hours, triggering algorithmic sell-offs. The price would crash. Retail investors would panic and sell. JP Morgan would buy back their shorts at a lower price and pocket the difference. This wasn't a conspiracy theory. In 2020, JP Morgan paid $920 million to settle charges of spoofing and market manipulation in precious metals. The Department of Justice called it a decade-long scheme. The fines were paid. The mechanism continued. But the trap was forming. While JP Morgan was creating artificial supply with paper contracts, physical inventory was draining. Industrial demand for silver was accelerating. Solar panels require 20 grams of silver per panel. Electric vehicles use up to 1 kilogram per car. 5G infrastructure needs silver for every antenna. The world was consuming more silver than mines could produce. The deficit was being filled by above-ground stockpiles. By 2023, those stockpiles were running low. COMEX warehouse inventories dropped from 400 million ounces in 2021 to under 300 million by late 2024. The paper market was expanding. The physical market was contracting. This is the setup for every commodity squeeze in history. The turning point came when industrial demand made the short position unhedgeable. A hedge is when you offset risk by taking an opposite position. If you're short silver futures, you hedge by buying physical silver or long futures contracts. But when physical silver becomes scarce, hedging becomes expensive. JP Morgan couldn't buy 400 million ounces of physical silver without spiking the price against themselves. They were trapped in a paper position with no physical exit. Now let's talk about $65. For months, every time silver approached $65 per ounce, it would crash. This wasn't random. $65 was JP Morgan's psychological defense line. Above this price, their losses became visible to shareholders. Above this price, margin calls would trigger. Above this price, the entire short position would start hemorrhaging capital. So they defended it. Algorithmic sell programs, coordinated dumps during Asian trading hours, anything to keep the price below $65. Here's the math on their exposure. For every $1 that silver rises, a short position of 400 million ounces loses 400 million. When silver broke $60, they were already underwater. At $65, they were down $2 billion from their average entry point around 55s. But the real danger was not the current loss. It was the acceleration. If silver went to $70, the loss would be $6 billion. At $80, it would be $10 billion. At $100, it would exceed their quarterly earnings. This is why $65 was the line. It wasn't just a technical level. It was the threshold of institutional survival. The trap was complete. They couldn't cover without spiking the price. They couldn't add more shorts because their credit lines were maxed. They couldn't deliver physical metal because it didn't exist in the quantities they promised. All they could do was defend $65 and hope demand would collapse. It didn't. December 17th proved that. December 17th, 2025. Silver opened at 64.28. By 9:47 a.m. Eastern, it touched 66.50. That's a 2:30 move in under an hour. This wasn't gradual accumulation. This was a vertical spike. The mechanism behind it wasn't retail buying. It wasn't industrial demand. It was gamma. And if you understand gamma, you understand why JP Morgan had no defense. Gamma is an options market term. It measures how fast a market maker's risk changes as the underlying price moves. Think of market makers as the house in a casino. They sell options contracts to speculators. When someone buys a call option at the $65 strike price, they're betting silver will go above $65. The market maker sells them that option and collects the premium. As long as silver stays below $65, the option expires worthless. The market maker keeps the premium. Easy profit. But the moment silver crosses 65, the math inverts. The call option becomes valuable. The market maker is now on the hook to deliver silver at $65, even though the market price is higher. They're losing money on every contract they sold. To protect themselves, they hedge. They buy silver futures to offset the risk. This is where gamma becomes dangerous. When silver hit 65.10, the market maker's computers started buying futures to hedge their exposure. That buying pushed the price to 65.30. At 65.30, their risk increased again because more call options were now in the money, so the computers bought more futures. That pushed the price to $65.60. More risk, more buying. $66, more buying. $66.50. This is the gamma squeeze. It's a forced feedback loop. The act of hedging creates the price movement that requires more hedging. The call option wall at $65 was massive. Open interest data from December 16th showed over 50,000 call option contracts clustered at the $65 strike. That's 250 million ounces of silver exposure. When the price broke through, every single one of those contracts went into the money simultaneously. The market makers had to hedge 250 million ounces in a market that trades maybe 100 million ounces on a normal day. The buying pressure was instant and overwhelming. Here's the exact sequence. At 9:32 a.m., silver was at $64.85. A large buy order hit the market, 5,000 contracts. That's 25 million ounces. The price jumped to $65.15. That triggered the first wave of gamma hedging. Market makers bought 10,000 contracts to cover their delta exposure. Price went to $65.40. That triggered the second wave. Another 8,000 contracts. Price hit $65.75. By 9:47 a.m., the price peaked at 66.50s. The volume in that 15-minute window was 3 times the daily average. This is identical to what happened with GameStop in January 2021. Retail investors bought call options. The price crossed a critical strike level. Market makers were forced to buy the stock to hedge. Their buying pushed the price higher. That triggered more hedging. The stock went from $40 to $400 in 3 weeks. The mechanics are identical. The only difference is the asset class. Now, why did silver pull back to 65.80? Because humans stepped in. Professional traders saw the vertical line on their screens and took profits. They sold into the gamma squeeze. The algorithmic buying exhausted itself. There were no more call options to hedge above 66.50. The pressure released. The price fell back. But here's what matters: the retest. When an asset breaks through a major resistance level and then pulls back to test that level as support, it's called a retest. This is healthy. If silver had kept going straight to $70, it would have crashed just as fast. Vertical moves don't hold, but a breakout followed by a retest and consolidation, that's the foundation for the next leg up. Silver is currently holding $65.80. That's 80 cents above the old resistance. As long as it stays above $65, the breakout is confirmed. The old ceiling becomes the new floor. And the short sellers who defended $65 for months, they're now trapped above it. The screen shows $65.80. But that's not the real price. That's the paper price. The price of a promise to deliver silver in New York next month. Walk into the physical market and you enter a different reality. Industrial buyers are paying $70 right now, not because they want to, because they have to. A solar panel factory runs $1 million per hour. If the silver paste runs out, the line stops. The supplier says we can get you silver at $65.80 in 3 weeks or $70 today from emergency reserves. You pay $70. The cost of the metal is nothing compared to the cost of stopping production. This shadow price is exploding across the supply chain. Electronics manufacturers are bypassing the exchanges entirely. They're going directly to mines and refiners, offering cash bonuses to jump the line. Physical always wins when paper leverage breaks. JP Morgan's $2.4 billion loss is just the beginning. The wealth transfer is already happening. Watch open interest and dealer premiums. That's where the next stage reveals itself. Subscribe to track the squeeze.